Hi, welcome to the second session of the Investment Philosophies class. In this session, we're going to talk in at least general terms about risk. Risk is a theme in investing. You can't make it go away. It's a constant source of debate. And in spite of all of the movements we've made in finance, there is really no consensus on how to define and measure risk. And in fact, in this session, I'm going to describe risk as a double-edged sword. Let me start with that. I know there are lots of definitions of risk. Many are statistical, and I think they miss the point. In fact, much of risk management is built on the presumption that risk is a bad thing, it's a negative. I think the best definition of risk I've ever seen is the Chinese symbol for crisis/big risk. And it's a combination of two symbols. The first one is a symbol for danger. The second one is a symbol for opportunity. Put simply, risk is danger plus opportunity. Perfect way to think about risk because it locks the two at the hip. It says if you want one, you got to live with the other. Now we know which one we want. We want opportunity. But this definition says you want more opportunity, you got to be willing to live with more danger. One way to think about the discussion of risk and return we're going to have is when you're an investor and you expose yourself to danger in an investment, the question you're asking is how much opportunity do I need to compensate for that danger? Using a phrase I've used before, we're not bungee jumpers in investing. We don't take risk for the sake of taking risk. We take risk because we think we can earn a return that is higher because of that risk. With that lead in, let's talk about the different dimensions on which you can measure risk. When you invest in a stock or any financial asset, there's price risk from the price of the asset moving from period to period. And there's cash flow risk, which is the cash flows you're expecting to get on that asset can change over time, be different from what you expected. So there are two ways in which investors can think about the risk in investing. One is as the variability in the price. The more variable the price, the riskier the investment. But there are some intrinsic value people argue that the price is set by the market, which can make mistakes, that you should be really looking at the variance in the cash flows you get. So if you're investing in stocks, that the variance in earnings and dividends should be what drives your thinking about risk. Price risk versus cash flow risk. You also have total risk versus downside risk. We'll draw this contrast more deeply when we look at the statistical measure of risk, but total risk looks at both the risk that you get outcomes that are worse than expected, which is what we generally think of when we think about risk, but also better than expected. Total risk looks at both upside and downside. Downside risk, you focus only on that dimension of risk where you think you're going to be hurt. And there's a third dimension, which I think is a pretty critical one in investing. When you look at an investment, you can look at the risk on a standalone basis. You can look at Apple or Nvidia and say, this is the risk of investing in this stock. Or you can look at the risk that that stock adds to a portfolio. You might wonder, what's the difference? The difference can be very large, and we'll talk about why that's become the central theme in portfolio theory, the way we think about risk being the risk added to a portfolio. So let's get the process started with a couple of basic propositions. The first proposition is if you're unwilling to take any risk, expose yourself to any risk, you shouldn't expect to get a return higher than the risk-free rate. You should be able to earn what you can earn on a risk-free investment. But I'll give you an escape clause. It's called the arbitrage clause. If you can find a riskless investment that earns more than a risk-free rate, you found a profit machine. You're saying, what is the chance I have of finding something like that? Later in this class, we're going to talk about arbitrage investment philosophy where people try to do exactly that. Find a way to lock in a riskless investment and earn more than the riskless rate. The second proposition, in a market that is efficient, but things are priced the way they should be, your expected return will go up only if you're willing to take on more risk. In other words, your expected return and risk exposure are locked at the hip. Here again, I'll give you an escape hatch. The hope of those who hope to beat the market, and we'll talk about how this plays out in market efficiency and inefficiency, is that you can find a way to invest and earn a higher return than you should given the risk you're exposed to. That's an excess return. So that's a risk and return standing point. Let's talk a little bit about price risk before we look at the different variations on measuring risk. Price risk is the risk that comes from the price of your asset moving from period to period. And when you look at that number, you can compute it statistically as a standard deviation. So if I gave you the stock prices for a stock over the last 120 months, you can compute the standard deviation in prices. There's a catch though. If your stock is highly priced, you know what I mean by highly priced, it's a $500 stock per share or $1,000 per share, its standard deviation in dollar terms is going to be much greater than if it's a $10 stock. That's going to make standard deviations almost impossible to compute. So usually when people compute price risk measures, they try to do it on a standardized basis. You see, what does that mean? You can look at the percentage return in the price rather than the dollar change in the price. The standard deviation, that percentage return, can be compared across different investments, not just across stocks, across bonds and across real assets. So when we look at standard deviation, we tend to look at standard deviations in changes or percentage changes in a stock. So let's take an example. This is a single stock, Disney, from 2008 to 2013. I collected the prices for the stock. I also collected dividends. Why? Because as an investor in Disney, you're going to get that as an additional return in the months in which the stock pays a dividend. What you see here in the green line is the Disney stock price. And you can see that the axis goes from 0 to 100. The stock went from about $30 to about $65. Over the period, it almost doubled. That's good, right? All I've done with the red line is taken the percentage changes in prices every month. If I look at the standard deviation in the price, it's $12.47. I'm not sure what I can do with that because that is affected by the price level. But the percentage standard deviation of 7.64% that you see in returns, I can compare across stocks, across investments. In fact, there's a variant that financial academics and researchers sometimes use where instead of looking at percentage returns, you look at the log price. You have to trust me on this one, but log price is very much like a percentage return. It has better properties statistically in some ways, but you're trying to standardize again. That's for an individual stock. Now, in this graph, I look at all US stocks versus T-bonds. In fact, I look at stocks, T-bonds, T-bills, and corporate bonds. I know this graph is almost impossible to read outside of the S&P 500 stocks. And you can see that stocks have more zigs and zags, bigger zigs and zags than T-bonds and T-bills. And you can compute the standard deviation again in percentage stock prices, which is about 20%. But bond price standard deviation is much lower and T-bill standard deviation is even lower. When we think about risk in investing, I know this is lazy. We've ended up using standard deviation and percentage changes because it's comparable across investments. So let's pause and think about the variance we talked about before, downside versus total risk. Let's start with the obvious. As investors, nobody lies awake at night wondering, what happened to the stock? The stock doubles in price. It's downside risk that creates pain. So when we think about risk, we tend to think in terms of downside risk. The standard deviations I talked about, look at both sides, right? You can have a high standard deviation for a stock that went up 500% because the price variation was high. Standard deviations look at total risk, and there are people, in fact, who argue that that's a problem with standard deviation. There's a way in which you can compute the standard deviation variance only in returns that fall below the average return, or just a measure of downside risk. So total risk versus downside risk, and the reason we often focus on total risk is it turns out the world doesn't give you freebies. Then when there's a lot of upside, there's often a lot of downside. When there's less upside, there's less downside. Total risk and downside standard deviations are very highly correlated. You can use one as a stand-in for the other. Second contrast, we talked about this earlier, the risk in the cash flows versus the risk in the price. If you're an intrinsic value investor, you buy an investment for its cash flows. So from your perspective, you could argue the way you think about risk is not by looking at what a market price does, because markets make mistakes, but by looking at a variance in earnings or cash flows. We'll come back and discuss this more when we talk about value investing. Because here again, it's a false choice. Most companies which have high variance earnings and cash flows will have high variance stock price. But it's true, sometimes the two might give you different signals. The other problem with earnings and cash flows, they get measured 4 times a year for US companies. Every time an earnings report comes out, stock prices are continuous. They change minute by minute, hour by hour, and they can be updated constantly. Cash flow risk versus price risk. And finally, the contrast that I think we should spend a little bit more time on is the risk of a company standing alone, investment standing alone, as opposed to the risk that it adds to a portfolio. In fact, we can argue that finance as we know it was born out of one man, Harry Markowitz, walking into a library in the early 50s and getting caught up in this issue of, hey, why do we think of risk in terms of a stock alone when in fact we have portfolios? That the risk added to a portfolio should be the way we think about risk. Now, to see why the two could be different, let's go back to what happens when you go from 1 stock to 2 stocks to 5 stocks to 10 stocks to 50 stocks in your portfolio. First, each investment becomes a smaller percent of the portfolio. So the investment has a bad day or a good day, the effect on your portfolio will be much smaller. But here's the other and much more critical aspect. On each of these stocks, things can happen that are specific to the stock, right? Good things, bad things. And the law of large numbers becomes the mechanism that plays out across your portfolio. In other words, if you have 50 stocks, you might have 3 stocks where something good happens, 3 stocks where something bad happens, and 44 stocks where nothing happens. There's an averaging out that happens over time. That ladder benefit of the averaging out is going to be greater if your investments if every investment that you have moves in proportion to the other investments, there's no benefit. But the less they move together, the greater the benefit. This is what we capture with a correlation across investments. Now, I can show this benefit very simply with a statistical effect. What I've done here is looked at what happens, the standard deviation of a portfolio as you go from 1 stock to 50 stocks. See that first line, nothing happens. You say, how come? Because that's a scenario where the correlation is 1. The stocks move in perfect proportion to each other. As the correlation decreases, the benefits to having a portfolio increase. In fact, at the limit, if you have 50 uncorrelated assets, the standard deviation of the portfolio is only 5%, even though the individual investments you put in each had 4. This is portfolio magic. And I'll also tell you that if you put 50 stocks together, there's almost 0 chance that they will be uncorrelated with each other, have a correlation of 0. But even if they have a correlation of 0.6 or 0.8, which is a pretty high correlation, look at the benefits you still get. With a 0.6 correlation, your standard deviation goes from 40% down to 32%. That's the benefit of diversification. So when you think about risk, here's the bottom line. We can disagree about how to measure risk. Price risk versus cash flow risk. We can upside risk versus downside risk. But to argue that risk doesn't matter as an investor is foolhardy. Risk always does matter. And if you have different investment philosophies, you can come up with different measures of risk. If you're a true intrinsic value investor, you might decide your measure of risk is cash flow risk and only downside cash flow risk. Perfectly okay. If you're a trader, your risk might be total risk because that's what you think benefits you and in price. Every investor has to come up with a risk measure that fits their way of thinking about the world. And then here's, I think, the part that troubles investors the most and the reason they're so reluctant to even measure risk. Once you measure the risk, you then have to look at the returns you earned given that risk and ask yourself, is this worth it? Is what I'm doing adding value? Or should I go back to doing whatever I did with the rest of my life and put my investing on autopilot? You see, what's investing on autopilot? We'll talk about it. There are ways you can invest today on autopilot where you don't have to make those judgments. So in this session, we've at least in generic terms talked about risk as both good and bad, danger plus opportunity. talked about the different perspectives on risk, cash flow versus price, total versus downside, portfolio versus standalone. But we have a foundation. The next couple of sessions, we'll take that foundation and use it to come up with specific ways of measuring risk, both in fixed income, bonds, as well as in equities. Thank you very much for listening, and I'll see you in the next session.